All right, so we tick all the boxes on the definition criteria. All right, now we come to the tricky bit. What about the recognition criteria? Can you tell me the first one? Probable occurrence. Is there probable occurrence that there's going to be a future benefit? Yep, very good. All right, excellent. And you can have the hardest one of all. Is there reliable measurement? You say no. Why do you say no? Okay, yeah, because it's been donated, so you don't know what it's worth. However, I'll tell you something that perhaps I haven't discussed yet, and I'll tell you what they actually do, all right? In a museum or an art gallery, if they're given stuff, as they most often do, that's how they acquire a lot of their exhibits. People donate them or lend them to the gallery for a certain period of time, and even though it costs them Zippo, they initially come into the books as a donation, but they then revalue it, all right? So they then revalue it to the market value. So they might get a valuer in and he will arrive at a figure, all right? And they do that for mainly insurance purposes, so that if it gets stolen or whatever, they have an amount that they can insure it for. But also for accounting purposes as well. It is necessary that when they do their inventory, and in a gallery they have all their paintings listed in their inventory and as their assets, and so they need to come up with some value. So it would be valued as per some sworn valuer who's an expert in this kind of paintings, right? And that would be obviously an approximation, but that's all a lot of those things are, approximations anyway. Okay, so the conclusion is, yes, it is an asset, right? Right, let's move to number 2. Right, number 2, contrast cash and accrual accounting. Now this one I think you can probably do off the top of your head, right? I don't need to give you time to think because it's basic, all right? So this is a good revision. So let me ask you, can you tell me what cash accounting is all about? Oh, you just enrolled, did you? Oh, all right. You missed last week's class, did you? Or? Oh, you just want to get information first. All right, okay. I'll leave you alone tonight. But I won't in future, all right? I'll give you a night's grace tonight, all right? Okay, I'll pick on someone else. What about you? Can you tell me what cash accounting is? Correct. So it's cash in, cash out. All right, that's what cash accounting is. If it hasn't derived any money in or money out, it doesn't get included in cash accounting. All right, accrual accounting. Can you tell me what accrual accounting is? Correct. And the same with income. Yeah. So it's based on when the transaction occurs or when it's passed and the expense has been derived. That's when we take up the accounting entry. So last week, those of you that were here, we did an exercise comparing various transactions under the cash and accrual accounting basis, and that showed you some significant differences. All right, the next part of the question was to define the accounting assumptions. Historical cost. Would you like to tell me what historical cost is?
Historical cost means that the assets and liabilities are assets are recorded at their original cost when the company has acquired.
Yep. So when they're initially acquired, they are shown at cost. That's correct. Yep. Excuse me. Going concern, the lady in the front. Yeah. What's a going concern? Yes, you. Correct. Okay, so going concern is about the company operating into the foreseeable future. It's not going to wind up very soon. And the last one, materiality, the lady next to her. Can you tell me what that is? So materiality is about things that are important or significant. So it emphasises that we need to concentrate on things that are important in the financial statement. Don't worry about the little things. Concentrate on the big things. All right, let's go to the next one. Right, this is another one that we have to use the conceptual framework. So I'll give you 5 minutes for this one as well. All right, 5 minutes to absorb what's going on here, and then we'll discuss it in a moment. Again, you've got to use your conceptual framework for this one. Yeah, that doesn't matter. Yep, because of this company, it's all about its organisation, it's all about promoting art and culture. So the economic doesn't have to be, so benefit doesn't have to be physical. No, that's correct. It can be intangible. Okay, let's continue. So we're going to discuss the conceptual framework for this one. So let's start on that table over there. So you guys can tell me, firstly, for the definition criteria, who'd like to talk about the future sacrifice of benefit? Do we tick the box for that or not? What do you think? Yes? Is that your answer? Oh, you're going to do the past event first. All right, that's easy. All right. Yep. What do you think about that? Is that okay? Why not? Thanks. Yep. Oh, all right. Oh, you can come and do it in a minute. Sorry? Because they haven't had the flood. Is that what you mean? Is that what you're talking about? They haven't had a flood, so therefore you wouldn't tick that box. Is that correct? Yep. Okay. All right. I've got your... Now I know what you're talking about. All right. I don't necessarily agree with you, but anyway. All right. What about the next one, the future economic sacrifice? Is there going to be a future sacrifice? The next gentleman there. What do you think? Yeah, okay. All right, what about the final one? Is there a present obligation? The next gentleman. Yep, you. What do you think about that? Okay, all right. So you don't think there is that correct? All right, well, we'll get to that in a moment. All right, is there anyone that thinks that it is a liability? Is there anyone in here who thinks that it's a liability? No one. So you all think that the company or the directors are wrong in doing this entry? Is that the way that people are thinking? Sorry, you want to say something? Yeah, what do you want to say?
Record it as a contingent liability.
It's what?
We cannot record it as a contingent liability.
No, I'm not saying it's a contingent liability. But are you saying that? You think it's a contingent liability? Is that your...
I think it can be, because if we see the pattern that the flood is coming in the last 20 mean, on an average, the shop floods also, but we're not sure whether the flood causes destructions or not. Like the flood causes damages to the shop or not.
Right.
But the floods occurs every year.
Well, but remember, one of the things that we have to do with accounting, and that's be conservative. All right. So if we're going to be conservative, we have to err on the side of caution. So if maybe sometimes the flood isn't as bad as another time, but if we err on the side of caution and provide a bit more, what's wrong with that? It's better than not providing at all, isn't it? Because the whole purpose of accounting is that we don't overstate our profits. And if this company decides they don't want to carry insurance because it costs too much, and they're prepared to take the risk of the weather, then they have to bear the brunt of whatever happens to their shop. So it's similar to let's say we've got a mining company, all right? And the mining company have or know that they're going to do some restoration to their mine in the future, all right? In the future, maybe in 10 years' time or 20 years' time, they're going to have to fill it in, or they're going to have to grow some vegetation over it when they're finished doing their mining. All right? They don't know how much it's going to cost. They don't know when that's going to happen, but they know it probably will happen at some stage. So they still carry a liability. All right? They still carry a liability, and they pro-rata that liability each year so that it's not carried in one particular year. And the whole reason behind that is that if we wait until the flood actually occurs, then our income is going to be very lumpy, isn't it? In the year that we have a flood, our income's going to go down like this, and then the years we don't have a flood, it's going to be up like that. So in order to make it more even and matching, it's probably okay for the directors to process that entry, in my view. All right? And I would actually concur with that treatment. All right? Now, as I mentioned to some of you, particularly in relation to the present obligation. When we talked about present obligation last week, in fact, we only talked about it in relation to contracts. But there are three types of present obligation. There's the legal obligation that we talked about last time, and then there's a constructive obligation and an equitable obligation. So the constructive obligation is something that they do out of practice, all right? So in the case of a mining company, they are providing for this restitution of the environment. In the case of a shop, they are regularly providing for flood losses because the shop is in a flood-prone district. So that's constructive, and then we've got the equitable obligation, which means that you're trying to restore things back to their equity and make sure that it's appropriate. So they are the three, and we'll talk more about them when we do liabilities a little bit later on. Okay, let's now go to this one. All right, that one we might not do. Actually, I'll get you to do it yourself, all right? But what I want to do before you do it, I'll get you to do it at home, all right? Because I want you to do it at home. So what we're going to do is we're just going to go down, and I want you to tell me which statement things go in, so that when we prepare these statements, you're not putting expenses in the balance sheet, or you're not putting liabilities in the profit and loss statement, because when we get to the exam, you'd be surprised all sorts of funny things I see in the reports that people prepare for the exam. So let's go with accounts receivable. We've got to say whether it's in the income statement or the balance sheet or neither. Right, where would you see that? Yep, balance sheet, correct. Accounts payable, balance sheet. Rent, correct. Cash, balance sheet. Sales, income statement. Cost of goods sold, income statement. Electricity, correct. Building, balance sheet. Inventory, correct. Land, balance sheet. Loan, balance sheet. Furniture and fittings, correct. Advertising, income statement. Retained profit, balance sheet. Share capital, all right. Dividend declared, income statement. Dividend payable. Huh? What did you say then? Dividend payable. Wrong. Has to be the balance sheet. Payable means it's an obligation to pay. Yeah. All right, you slipped up on one. I'll let you have one mistake. All right. Depreciation expense. Yep, income statement. Accumulated depreciation is in the balance sheet, correct. Okay, so that gives you a good heads up. So I want you to do that one and do your calculations of the income statement and the balance sheet. And that one says it's worth 10 marks, so that would be around 12 minutes you would have for that. All right, so there's the solutions, and I don't want you to look at the solutions, I just want you to do them without looking at solutions, okay? All right, so that's that. Now, there's the practice quizzes, all right? Now, I'm not going to go through the practice quizzes. I would like all of you to do the practice quiz yourself each week without my prompting. Okay, let's now start the topic 2. If we have more time, we'll do some more exercises at the end, but we'll just see how we go. So let's begin topic 2. So tonight we'll be looking at the recording of business transactions, including the accounting cycle, debits and credits, and ledgers, journals, and the trial balance. These are the things that you should be able to come to grips with after completing this topic. All right. All right, so this was just the one of the revision questions, and it was asking you, explain why Academies Australia is prohibited from recognising tuition revenue at the time of student enrolment. All right, can someone tell me the answer to that? I mean, it could well be Deakin University, for example. All right, so you people pay your fees for the tuition, so why can't Deakin, or in this case Academies Australia, recognise the revenue when you enrol? Why not? So are you saying that if we recognise it at the time of enrolment, it's the cash basis, isn't it? Yeah? Correct. The service has not been provided. So they should recognise it periodically over the term, shouldn't they? Yeah? I don't know if that's what they do, but I hope that's what they do. I hope that's what they do. All right, so we would go back and look at the conceptual framework and say that the service hasn't provided, and so therefore we're not entitled to recognise it as a revenue. And that's the answer there. So there's no impact on equity. Okay, let's now look at the accounting cycle. So the accounting cycle focuses on 3 key points. One is the identification, which is the inputs, where we collect the data and look at the source documents. The next one is the measuring and the recording, which is where they focus in the books. So that's what we'll be concentrating on tonight. Measuring and recording transactions. And then the third part is the output, the financial statements themselves. This is another way of looking at it. If we break it down into 8 steps, we have the source document, the journal, the ledger, the trial balance, the adjusting entries, the closing entries, the post-closing trial balance, and then the financial statement. So we will be going through all of those things during the course of this unit. But today's class will be just looking at the first 4. Okay, so what is an example of a source document? Yeah, a receipt or a payment or an invoice or a bank statement, all of those things could be source documents. Because the source document is the originating piece of documentation that we need to process to justify that the transaction has occurred. It's often used in disputes. For example, somebody says, I'm not paying this because you haven't delivered the goods to me. Or I'm not paying this because I haven't received an invoice or whatever. So we go back and check the documents and then work out who's right. It's also used for auditing. So when the auditor is doing his work after the accounts have been prepared, he will be examining some of these documents on a sample basis to make sure that everything is in order. And these are some examples, like what you guys said a minute ago. Right, now you're going to try and tell me what would be the source document for each of those. Right, what is the source document for a credit sale? What is the source document when you pay a creditor, or if you pay a stationery expense, or if you receive cash from a debtor, or if you receive goods on credit? Okay, so just write down your answer for each of those 5. Okay, so what is your document for the credit sale? What did you say? Yep. Who said that? I heard somebody whisper it, but who said it? Was it you? Sales invoice, okay, that sounds pretty good to me. Yep. What about paying the creditor? Yeah, it could be an EFT payment or a cheque, yeah, depending on how you choose. What about the stationery? Yeah, or it could be petty cash. Again, it depends on how much the stationery is. Sometimes if the stationery is a trivial amount, that's why they put petty cash voucher, right? Because we might buy pencils or a sharpener or a rubber or something like that, and so we would have usually a petty cash box with some loose change in there, and we might say to the custodian, oh, we need about $5 to go down to the newsagents to get something or other, and they'll say, all right, well, get a receipt and I'll write out a voucher for it, and that's what happens. Right, next one, receiving cash from a debtor. Remittance advice, all right? Usually when we send out our invoice or statement, at the bottom we have a perforated little attachment, and that's called the remittance advice. So he will tear that off and send it back with his payment. Right, and the last one is receiving goods on credit. Yeah, a supplier's invoice or purchaser's invoice. Excuse me. So once we've got our source documents, the next thing that we need to do is to record them. And the basis of our recording is following the accounting equation. So if we recollect, our accounting equation is A equals L plus OE. And the other important thing to remember is that we use double entry accounting in Australia, which means that every transaction has at least two effects, at least two. If it's a single transaction, it's usually two accounts, but if it's a compound transaction, it might be more than two. So we have to keep that in mind when we look at various transactions. So let's look at this one. The owner contributes $50,000 to the business, right? What would be the transactions that are affected, or not say the transactions, the accounts that are affected in this transaction? Cash and what? Capital, correct, that's right. So our cash is going up, right? Asset cash, and the capital is going up. So in terms of our owner's equity, that's increasing, and this side is increasing too. Because essentially, when we do our effects, both sides should balance. We can't have this one going up and this one going down. That doesn't work. They both have to go up or both have to go down, otherwise it's not going to remain in balance. So that's the solution to that one. Let's look at the next one. Purchasing some equipment for cash. Yep, cash obviously, and equipment, all right? So equipment is an asset and cash is an asset. So we have one asset going up and one asset going down. So effectively the equation is still in balance. All right, number 3, purchasing a motor vehicle for credit. So the asset is motor vehicle going up, and the liability, which is the future loan that we have to pay, right? So that increases as well. So our asset goes up and our liabilities go up. Right, number 4, we pay our creditors $5,000. Yeah, cash would go down because it's coming out of our bank account, and our liabilities go down. Yep, both go down. Number 5, received $10,000 from the debtors. Yeah, so here we've got our assets increasing for cash and our debtors decreasing for the accounts receivable. Okay, I think that's pretty good. Did anyone struggle with that or have any problems with identifying which accounts? No? Okay, so the next step we're going to do is to enter the transactions in the journal. So we're going to be looking at how do we record those transactions in our journal. First thing that we have to remember when we go through the transactions is that we do them in chronological order. That's in order of occurrence. And the other thing that we have to remember is that after we prepare the journal entry, we have to explain what it is. So we do a little bit of a narration to explain the nature of the entry, because if someone wants to read about it later on, they want to know why was this entry, why was it put through the books. So we do a journal entry approach, and again we use the double entry system that we discussed before, and we also have to associate a debit or a credit with each of those entries, because we put the debits on the left and the credits on the right. Now, why do we do that? Because the gentleman that invented accounting, I think his name was Louis Baccoli, back in 1494 or some date around that time, and he was the one that's responsible for the debits and the credits, so we can all blame him, all right? He's not here to defend himself, of course. He obviously, but he left behind a system of accounting that we still use today. And another golden rule that he left us with was that for every debit there must be a corresponding credit. So we don't have any one-sided entries. Everything must be two-sided. And I'll emphasise that for when you're doing your assignments. When you're doing your assignments, you'd be surprised, having gone through and said this, everything must have two sides. When I see the assignments, there's many one-sided entries, all right? Or what some people tend to do, so that I don't notice, they put in a balancing item, all right? So if their debits and credits don't equal, they say, oh my God, what am I going to do? I'll try and hide it. So they put in balancing item, or they might add it to the capital of the person and hope I don't see it. All right? So whatever the difference is, that goes in as the historical recording, whatever they want to call it, or they call it all sorts of strange names. So my word of warning to you, if it doesn't balance, keep working on it, because I will pick it up. All right? I check things very thoroughly. So you can't fool me in your assignments. I will be checking every single figure, every line, every amount, and making sure that it's on the correct side and it's a debit or a credit, and that it all balances. So make sure you do it systematically and methodically. Right, next thing is the ledger. So from the ledger, I should say from the journals, we post to the ledger. So the ledger is a record of each item in our financial statement. So we have a ledger account for bank, we have a ledger account for motor vehicles, creditors, wages, salaries, sales, whatever. Every single account that we talked about, you have a ledger account for. And this gives you the transactions that occur in that particular account for the whole accounting period. So if that's a year, you'll see all the transactions affecting bank for the whole year, and the same for motor vehicle and so on. And in the ledger accounts, we also have to remember when we're posting things from the journals to the ledger, make sure we do both sides of posting. We don't just do one side and forget the other. Because if your ledger accounts are out and they don't balance, then there's a fair chance that that's what you've done. You've transposed a figure incorrectly, or you forgot to post one of the sides of the equation. All right, so that's our golden rule. Debits to the left, credits to the right. All right, or when I was doing my accounting, we used to sit in the class and they'd say debits to the window side and credits to the board. All right, that was just the way the room was set up. So it's just an easy way to remember where to put things. So let's look at a transaction. So the transaction we're going to start with is the customer paying their month's credit sales. So when we record the sale, we recognise the sale and we recognise the account receivable for that sale. So the account receivable is an asset, and when we recognise it, we debit it, because the golden rule is that assets are normally debits and liabilities are normally credits. So what's happened in this case is the asset accounts receivable has gone down because the customer has now paid and they don't owe us anything. So that asset goes down, but the asset cash goes up because the money that they paid us goes into our bank account. So we have one asset going up and one going down. Right, so this is the golden rules that you need to remember, and this is probably the most important slide for tonight. So our assets equals our liabilities plus our owner's equity, and the assets, as we said, are debits, the liabilities are normally credits, and the owner's equity is normally a credit. When we say normally, that's what it would be if the account is increasing. If it's decreasing, then it's the other way around. It will be the reverse. It will go down. So it will be a credit and these ones will be a debit. So if we restate the whole accounting equation, the capital is a credit, the retained profits are a credit, the revenue is a credit, the expenses are debits, and the dividends are debits. So another way of restating it is to put all the debits on one side and all the credits on the other, if that makes it easier for you to understand. Here's another way of expressing it in a little table. And as Ali has said, never to be forgotten in your whole accounting career, because this is the basis of what accounting is all about. Okay, so the natural balance is the one that normally occurs. If it increases, it will be the same as the natural balance, and if it decreases, it will be the opposite. And it is. Okay, so we're going to give you a little test now, all right? And I'll give you, let's say, 5 minutes to do this. So I want you, for each of those 22 items, tell me whether it's a debit or a credit. Just put it in the box there, and we'll go through the solution in a moment. Is it normally a debit or a credit? So the first thing you need to know is, what is the nature of each account? Is it an asset, a liability, or an expense, or a revenue? And when you know that, then you relate to that little table that we had on the previous slide, and you can say whether it's a debit or a credit. Okay? All right, 5 minutes to do that little exercise. Okay, how are we going, folks? Are we nearly finished? Yep, okay. All right, we're going to go through them now, and most of you have finished. A few haven't, but we can't wait all day. So let's go through our answers. Right, inventory was a debit because it's an asset. Revenue received in advance is a liability, so it should be a credit. Cash at bank, an asset, so it should be a debit. Accounts payable, a liability, so that's a credit. Retained profits is part of equity, so that's a credit. Cost of goods sold is an expense, so that's a debit. Equipment is an asset, so that's also a debit. Accumulated depreciation is a negative asset, so that's a credit. Depreciation expense should be a debit. Dividends, and I'll assume that's a dividends expense, so it should be a debit. Sales, revenue, so that's a credit. Number 12, prepayments are assets, so they're debits. The general reserve is part of owner's equity, so it should be a credit. Capital, also a credit. Wages is a debit. The loan is a liability, so that's a credit. Accounts receivable is an asset, so that's a debit. Provision for warranty is a liability, so that's a credit. Income tax is an expense, so that's a debit. Tax payable is a liability, a credit. Land is an asset, so that's a debit. And interest revenue should be a credit. All right, tick them off, folks. All right, did anyone get 22 out of 22? No? What did you slip up on? Pardon? Number 22? Ah, right, okay. Ah, right, okay, all right. So you got 21, is that right? Did anyone do better than 21? No? Okay, all right. Well, you're the leader in the clubhouse tonight, all right. Okay, very good. Well, I hope you all got at least a pass. Okay, so we'll come back to journal entries. So when we're recording things in the journal tonight, we're going to be looking at the general journal. And the general journal is, as the name implies, a general all-round sort of book. And it's often referred to as the book of original entry, where we originally enter our source documents. It also is where we record all of these transactions, but later on, when we come to looking at other journals, which we'll do in a few weeks' time, you'll see that because there may be too many entries in the general journal, it becomes very unwieldy and difficult to find things. So we separate them out into different categories. So we have journals for all sorts of different things like sales and purchases and payments and receipts, and we might have a journal for wages, we might have a journal for returns, etc. So So then we're left with only a few things in the general journal, which will be adjustments and closing entries. So for now, we're just going to put everything in the journal until we discuss the other journals later on. So this is the way that we put them in the journal, and you can see here that in a journal we will have various columns. So the first column is the date it occurred. The second column is the particulars, which relate to the account. And under the particulars we will have some brief explanation of what the transaction is all about. We also may have some reference to help identify the transaction. It could be a check number, or it could be an account number, or something that we want to put in there. And then we have the value of the transaction, both for the debit and the credit, and as we said, they should be the same. So that's the standard format for a general journal. Looks something like that. So as it says there, when we get to week 4, we're going to introduce special journals. So some of the things that we're talking about putting in the general journal now will be in a special journal later on. All right, so let's look at some examples of general journals. The first one is the interest. So on the 11th of June, we received interest amounting to $2,000. So the $2,000 is coming into our bank account. So it's going to increase our bank account, so that's going to be a debit. And it's also, because interest is a revenue, we have to credit the interest account with the same amount. So that's the explanation for the first entry. And then of course we do the written explanation underneath to explain what it is. In this column here, in this occasion they've put the chart of accounts reference. So as it says in red there, we're going to explain that later, so I won't jump the gun, and I will talk about it a little bit later tonight. All right, the second entry is the insurance. So on the 21st of June, we paid insurance of $300. So insurance is an expense. So we debit the expense of $300 and we credit our bank account because it's reduced the bank account, which is an asset. The final one is the purchase of office desks for $1,000 on the 28th of June. So we debit our asset, office furniture, with $1,000 and credit the account payable with the same. The office furniture is an asset, so that's increasing, so that's why it's a debit. And the account payable is a liability because we owe money on the desk. We haven't paid for them yet. So we create a liability of $1,000 as an amount that we will settle in the future. Okay, I'm going to get you guys to do some recordings yourself. So there's 11 transactions there, and I'd like you to do exactly what I did on the previous slide. Process these transactions in a general journal. Each of the transactions, they all have two sides to them. So don't forget your debits and your credits. All right, it's about 6:20 now, so I'll give you 10 minutes to do that little task, and then we'll have a break. There's about 10 people that haven't ticked their names off this sheet. Oh, it's mostly you people. Well, I can pass it. All right, is there anyone now that still hasn't ticked their name off? Oh, you. All right. I see some of you are not using the following slides, maybe because you're not sure whether they're correct or not, and you're just putting them in on pieces of paper, but it doesn't really matter as long as you make sure you check the correct journal entry when we put them up on the screen in a moment. All right, I think we've given you long enough to do that particular task, so let's go through the answer. So the first one, the contribution to commence the business, was the same as one of the examples we had earlier. So we have to debit the money that's coming in, which in this case is 100,000, goes into the bank account, and we credit the capital. Right, second one, inventory being an asset gets debited, and because it's purchased on credit, we owe money for the inventory, so that's a liability, and we put it to accounts payable. Third one, selling the inventory on credit. And this one we have the accounts receivable. That is in the wrong column there. It should be in the debit. All right. So that's a bit of a typo there. Oh, sorry, it's just come up like that. All right, that's all right. So it came up that one first instead of that one. So we debit the accounts receivable and credit the sales revenue. Right, on the 5th, we know that the inventory cost us 25,600. So our cost of goods sold goes up because the inventory has been sold, and we reduce the inventory on hand. On the 10th of December, we purchased some inventory for cash. So the asset inventory goes up, so we debit it, and our bank account goes down, so we credit it. On the 15th, we pay our Optus account. So the account payable goes down, so that means we debit it. And our bank account goes down as well, so we credit that one. On the 18th, we make some sales for cash. So the bank account goes up, so that's a debit, and the accounts receivable gets credited. Next one is the rent paid to the landlord for the month of December. So our rent expense is debited and our bank account goes down, so that is credited. On the 21st, we had the electrician do some works. So that was for $12,000. It's an expense, so it's debited. And obviously our bank account goes down by the same amount, which is a credit. On the 24th, we paid wages to the employees, so that's an expense, so that gets debited. And the bank account goes down by the same, so we credit that one. And finally, on the 31st, we do our tax entry. So we create an income tax expense of $1,400 and credit income tax payable with the same, because that's a liability. Okay, some important notes before we move on. For every journal entry, make sure you enter an amount in and make sure there's at least two sides. Make sure that both debits and credits equal each other. Make sure that they're in chronological order. And also that you do a brief narration to explain what it relates to, so that people don't have to go searching. Okay, we're going to have a short break now. It's 6:35. So let's have a 10-minute adjournment and we'll resume at 6:45 or 6:45. And we'll then continue with the remainder of the slides. Okay, let's continue. So now we're going to talk about the general ledger. So from the general journal, we make our postings to the ledger. So the ledger shows the accumulation of transactions from the journals, but it's broken down into the individual accounts as we mentioned earlier. And the main reason why we do this is because some businesses have thousands of transactions each day, and it's going to be very difficult to try and work out what's going on if we just have a journal. So we have our ledger accounts to aggregate all those entries that have been occurring for each account. Now, there's different ways in which we can process them in the ledger. In your textbook, which is this one here, as some of you have I see on the desk, have already acquired, it will show the two different ways in which the journal entries can be processed. The first way is the T account, which is, we'll have a look at in a moment, where you've got your debits on the left and your credits on the right, and you enter them according to that structure. So that's probably the most common form and the one that most people tend to use. The other one is the columnar format, right? The columnar format is where we have them all in different columns and we do a rolling balance. But we'll talk more about that a little bit later. So the T account, we would have a heading which would give us the name of the account, and we would then have the movements in that account over the period. So if we've got an increase to that account, it'll go on that side, and if it's a decrease, it'll go on that side. So we record all the fluctuations to the account over the period. and likewise for liabilities and equities, expenses and income accounts. So effectively what we're doing is we're entering the transactions from the journal into the ledgers on exactly the same side. So if we have a debit in the journal, it appears as a debit in the relevant account. And if it's a credit in the journal, it'll be a credit in the relevant account. So don't change your accounts from the journal to the ledger, you don't. Right? They appear on exactly the same side as they do in the journal. And for every line item in your journal, you must have a ledger account entry. Doesn't matter what the item is, it's either going to be an expense, an asset, a liability, a revenue or an equity. So the ledger account effectively is a summary of all the transactions that have occurred during that accounting period. And then at the end of the period, we will calculate a balance of that account. So we'll add up the debits, add up the credits and work out which one is greater, and that will be our balance at that particular point in time. So the purpose of doing that is to get our accounts ready for the calculation of our profit and or loss, and also our assets and liabilities. Now, if we have an accounting system, and there's some examples there, we've got MYOB or MYOB, we've got Xero or XERO, we've got SAP, and we've got JD Edwards, and another one is QuickBooks, all right? So there's many different accounting systems or software that you can use. We're using Xero for your assignment, all right? So you'll need to know a little bit about Xero, and you can do that with the explanatory videos that have been posted on the website. All right, so now we're going to come back and talk about this chart of accounts. So the chart of accounts is in fact I suppose an index of all the account names and an arbitrary number that we have allocated to those accounts. So it gives us a listing of everything that we have in an account. Yep. Oh, you're just stretching, are you? Oh, okay, right. No worries. And we usually put some structure to them. So we would put them in some sort of order or system. A good idea is to link all your assets together and all your liabilities together and your expenses and your income and your equities so that it's easier to find. And with these chart of account numbers that we've allocated to the various accounts, we can use them in our posting references in the journal and also in the ledger. So this is just an example. These are not the ones that you have to use, but they're just some examples of an example of a system. So in this system, we're going to allocate all the 100 to 199 items as assets. Furthermore, we're going to divide those assets between current and non-current. So the current ones will fill the first 50 categories, and the non-current will fill the remaining 50. So if we have more, then obviously we should have a greater number of accounts. Maybe we'll have assets from 1 to 300 or whatever it might be. So then we do our liabilities, and again we're assuming that we've only